All right, it's live. So I talk all the time about the mistakes of the 1920s and 1930s and how a lot of them are being repeated or very, very similar. And this particular live stream show or podcast is not going to focus on the mistakes that President Trump has made and how they're very similar to what Herbert Hoover and Franklin Delano Roosevelt, or the mistakes of Congress and how they're right now, and how they're both houses of Congress, and how they're very similar to the mistakes that the U.S. Congress made during the 1920s and 1930s with Smoot-Hawley, or the mistakes that the Federal Reserve made in the 1920s and 1930s. I want to focus instead on the last empire, because the U.S. is an empire. The U.S. is running a massive, and I would argue unsustainable, welfare warfare state. So the last empire before the U.S., and a lot of historians call this the Anglo-American period right now. They kind of combine the two. They squish the two together. But the last empire was the British Empire. And really in a very short amount of time, due to two world wars, the British Empire did an unbelievable amount of currency devaluations. So history might not repeat exactly, but it does rhyme. And I suspect that in the not too distant future, perhaps less than 2 years, there will be very big dollar devaluations to deal with some of these debt problems. And a weaker dollar, actually, a lot of emerging markets with dollar-denominated debt would benefit from a weaker dollar because they have too much dollar-denominated debt and they don't have access to as much dollars right now because global trade is not functioning normally. Although they do have the global repo facility if they have U.S. treasuries that they can post as collateral, and then also the currency swap lines, which the Fed is being very liberal with right now. So as you can see there on your screen, in terms of currency devaluations, really the British Empire was running a very unsustainable welfare warfare state with colonialism for a very long time. If you want to get into details about this, there's the book out about devaluation and problems in the 1920s and 30s, The Lords of Finance, as you can see there on your screen. I think it won a Pulitzer Prize for history in 2010. So that is available on Audible audiobook, Kindle. I have the book. I haven't read it, but I've read tons and tons of articles about that historical period. And people ask me, where did you come up with the phrase stagflate and tax and lie? And really, it's a culmination of events where I've interviewed over 500 experts. I've hundreds and hundreds of different experts, inflationists, deflationists, Austrian school economists, people who are not Austrian school, just studying different perspectives, reading over 500 different books on financial history, investing, entrepreneurship, and it's a culmination of these things. And really, to study history, you have to see what's happened in the past, especially, and I think it's a good comparison with what happened with the last empire, because there was sometimes bouts of deflation in the British Empire, but then normally what happened to deal with debt is and this has happened in the U.S., whether it's the Plaza Accord, I think in 1985, where Germany and Japan went to the U.S. and asked the U.S. to devalue the dollar by 50%. Now, there was trade concessions. Most people aren't aware of the trade concessions. So that's what brought the factories, a lot of more factory jobs back to the U.S., was Ronald Reagan and his trade negotiating team. I think Bob Lighthizer was on there when he was a much younger adult. And in exchange for devaluing the dollar 50%, to help Germany, to help Japan with their dollar-denominated debt back then with the Plaza Accord, there was trade concessions where Toyota and other manufacturers, I think Mercedes-Benz and also BMW, had to move some factories back here. I think it was mostly Toyota, though. Toyota has a good amount of factories here in the United States. So there was tariffs that were put up. Reagan put up tariffs, and to jump the tariff barrier. So I could see something very similar playing out to what happened with the Plaza Accord happening in the not too distant future. Probably, if I were to guess, if things get worse, the U.S. debt gets worse, if the real economy does not start to improve and the cash flow problem does not get better, I could see a large dollar currency devaluation in under 2 years, maybe even a lot, maybe in the 6 to 12 month window, depending upon how much worse things get. So this is something that a lot of the dollar tug of war people, I don't think they're actually accounting for this. I've asked Brent Johnson about this, and he says it's a possibility, but I don't think he assigns it as a base case. But I think the people in power here in the U.S., in New York City, at the New York Fed, and here in D.C., whether it's President Trump, who's tweeted about it a lot, he wants a weaker dollar, the U.S. Treasury, and the Fed, they want a weaker dollar. Now, the problem is the dollar tug of war. So it's not as easy to devalue the dollar. So that's why I think there might have to be some type of arrangement similar to what a Plaza Accord, where they sit down with other trading partners and they agree to some type of dollar devaluation. So let me talk more about the currency devaluations and how a lot of the similarities to the British Empire, especially after World War I and during and after World War II, although the U.S. is not in an actual, large-scale war, we have all these small wars with the military-industrial complex and the Pentagon going on and the massive amounts of military spending, but it's not a full-scale world war. But the amount of spending the U.S. military is doing is clearly unsustainable, although you are able, if you're running a government like this, with a debt-based fiat currency credit Ponzi scheme, you are able to finance big government, a welfare and warfare state, with more and more dollars, exporting them out, and doing a Ponzi scheme where the currency and credit has to keep growing, and then a lot of that monetary inflation is trapped in asset prices, in derivatives, and exported outside the U.S. And that's why here in the U.S., we only get mostly stagflation, and that's why the U.S. hasn't gotten hyperinflation, because the velocity of money here in the U.S. is not massive, and it's intentional to where a lot of that, the monetary inflation, is exported. Okay, so going back, American Express actually did a history of the British pound on their website. I'll put an information and description in this article in the information and description section. So originally this is going to sound familiar, originally a private institution created to fund the government, the Bank of England was nationalized in 1946, very similar to the merger that Jim Bianco of Bianco Research and Danielle DiMartino Booth have talked about in the last 3 or 4 months, how basically, according to the op-ed that Jim Bianco of Bianco Research wrote, I think in March, that the Fed and the Treasury are essentially merged now. So the Bank of England was nationalized by the British government in 1946 and is now wholly owned by the UK government. However, it did not become fully responsible for monetary policy until 1998, when it was granted operational independence. Now the bank's mandate and objectives are set by the government, but it's free to decide how to meet them. So the Bank of England has a dual mandate, though the two components of the mandate don't have equal weight. Primary monetary policy objective is to deliver price stability, which obviously faking inflation data, stagflate and tax and lie. But if you go back through studying history with the British economy over the decades, really during World War I, after World War I, obviously there were wage and price controls during the wars, but there was also a lot of argument over devaluing the currency back then as well. And then after, according to the book, The Lords of Finance, I've read the summary of the book, where they were arguing, the central bankers and the Bank of England central banker had the most power over what to do after World War I to go back on the gold standard. And Jim Rickards has talked about this, and others have talked about this as well, where they set the gold standard on the wrong price and it was highly deflationary because they didn't want to admit all of this inflation and currency and credit and debt had been created in World War I to finance the wars, so they didn't want to move the gold price back up, and it's considered a massive mistake in history. But if you study what happened in the British economy, they had really, really high taxes, they had really high regulation. I interviewed Dominic Frisby years ago about this, and I was looking through an old London newspaper that was documenting all of the inventions, the research and development, the patents, the innovation in the British economy. And there was tons and tons and tons of inventions. And right around the period there after World War I, they basically stopped to a trickle. So the British economy was creating all these new products, new services. They were creating an unbelievable amount of new products and services in their economy. And then it just stopped. And during that period when the innovation stopped, the taxes went high, The government debt was high. They were running a massive welfare warfare state, and there was back then they were using, I would say, more honest inflation statistics. So you had too much government debt. You had a welfare warfare state back then because they were still running an empire, although it was in massive decline. And then they were running high taxes. So they were doing, it wasn't called, and they also had, even though they had unemployment and inflation, they weren't calling it stagflation back then, but it was. So what did they do to deal, what did the British government and the Bank of England do to deal with all this? They started, this is unfortunately what Keynesians like to do, and what governments in the past before Keynesian economics did was clip coins. They devalue the currency. So when push comes to shove, when they screw things up royally, they almost always devalue the currency. So I think that's where we're headed again. There's going to be another big dollar devaluation. I don't know exactly when, but I think this is the path of least resistance for the people in power, because here in the Washington, D.C. metro area, look, President Trump promised to drain the swamp. Has he actually drained any of the swamp? Okay, the one thing that the Trump supporters point to is the 10,000 rules and regulations he cut. But how many federal government agencies, how many federal government employees have been actually cut? Okay, pretty much everyone here in the DC metro area working at the regulatory agencies, all the lower and mid-level and pretty upper mid-level, the non-political appointees that Trump didn't put in, they all hate him. And Trump has even put in people like John Bolton, who didn't even like him anyway. He should have never put Bolton in. Oh, that was such a mistake. So, learning from history, this is just going to be a quick, short live stream show. I'm not going to spend a lot of time talking about this. If you want to research this more, I highly recommend reading the book Lords of Finance, and also some of the articles that will be below this video in the information and description section. The British Empire, the empire before the US, got into very similar problems with total government debt and an unsustainable welfare warfare state. Their economy became so overly indebted, so much taxes, rules, and regulations, it could not adapt. It could not create new industries. It could not clear. Okay, deflation is actually the cure. Lower wages, lower prices on goods. If prices go low enough, people start to buy again. People start to save again. Okay, when there's a sale at the grocery store on something you like, or a sale at the electronics store, or a sale on computer items, people want to buy these things normally. But the Keynesians in power, the Keynesian economists or neo-Keynesians, and soon to be, I guess, MMT people, although the Keynesians are basically they've adopted the MMT, and the Republicans are probably going to sending out the next stimulus checks in the next 6 weeks or so. But they don't like deflation. Deflation is the answer. Deflation is the cure, as Peter Schiff says. They won't allow it. In a Ponzi scheme, that is our fiat currency and credit, deflation is the enemy. So I have almost 300 people watching this live stream show and hardly any likes. Please tap, click, or smash the like button. I almost got that one right. Yeah, I don't like John Bolton either. That was a big, big mistake on Trump's part. He should have never brought him in. So if you want to understand what's probably going to happen, go back and read the articles about the British economy after World War I, and then during and after World War II, and the decline. The Lords of Finance covers a lot of this. And how they didn't think in the British Empire, they thought they would never lose the world reserve currency. They thought the British pound would remain strong, and where is England today? And this is the path the US is on. So in only a few decades, England did massive currency devaluations. So in only about 36 years, the British pound was devalued by another, I didn't see the exact percentage on the 1931 devaluation, but it was over 50% in 30 years. And then, of course, George Soros did, well, it was already in trouble. The British pound was already in trouble before Stanley Druckenmiller and George Soros. Okay, some guy in here saying that China's not the enemy. I don't trust the Chinese government. You shouldn't either. The other comparison I wanted to make before I wrap up this short little show is that the US was transitioning to be the world reserve currency back then when the British Empire was losing their power. But back then the US had better rule of law. There was private property rights. The US had a lot more freedom and a lot more confidence to invest. And Chinese companies right now have accounting scandals and other problems. So there are businesses investing in China, but I would not want to be one of them. And also, if you pay attention on Twitter to Deep Throat IPO, he explains the scam that is the Chinese currency, how there's a version of the currency that is inside of China and then a version of the currency that is outside of China. And the version of the Chinese currency that is inside of China is printed nonstop. And then the People's Bank of China protects the exchange rate outside of China. So, unfortunately, I don't think China has the private property rights and the rule of law to actually get a lot of foreign investment. Now, there's going to be foreign investment leaving China now with all the problems that has happened in the last 6 months. Especially with all the accounting scandals. But private property rights and rule of law, and if people don't trust the accounting, I mean, there's lots of Chinese companies. I've listened to money managers that are from China talk about how there's two sets of books with most Chinese companies. If you're a foreign investor and there's two sets of books, I can't invest there. Plus, China, the amount of credit in the Chinese economy has just gone absolutely bonkers inside of China in the last 10 years. Okay, one super chat here from Jonathan. Thank you for the super chat. Do you think the reason gold-silver ratio remains so high is because silver has lost its precious metal status and should be considered as a base metal? No. Nope, I think silver is even more manipulated than gold. The paper price of silver, I'm working on getting Chris Marcus, who has a new book out on the silver market. It's extensive, going back through the Hunt brothers, going back through Warren Buffett, trying to corner the silver market. It's on pre-order now. It's available on Amazon. You can get on pre-order. The amount of paper derivatives contracts on silver is way more. So as much as there's paper price manipulation on gold, there's even more paper price manipulation on silver. The other thing about silver that other experts don't talk about is on the supply side for silver. And that's because the majority of the annual silver supply is from base metal miners, copper miners, and they don't care about their silver at all. They don't care what price. The copper miners are willing to give all of that silver to the bullion bankers in exchange for cheaper loans. So I think there's a war on two fronts with silver. There's the supply side, how the majority of the supply side is by, I would say, price insensitive silver producers. So the base metal miners, the copper and base metal miners that produce silver as a byproduct, they produce silver at a insensitive price. So that's part of the problem. The majority of silver is by far the commodity with the most supply produced by a byproduct. I think it might be double the next commodity. So silver is the silver manipulation, the silver market problems, and why it's capped. It's a war on two fronts. I was debating writing an article about this. Maybe I'll write an article about this in the future for my Patreon account contributors. Anthony says, so the copper miners are selling us out on silver. Yes, But they don't know about the paper price manipulation. They just don't care. The copper miners are trying to survive. So if the bullion bankers tell the copper miners that if the bullion bankers go to the copper miners and say, we will give you investment into your company, help you raise equity shares, or give you better lower interest rates on credit in exchange for the silver, the copper miners will do it immediately. So you have a situation where the copper miners are willing to hand over their silver to save themselves. So we need to see the supply, the annual silver supply, shift away from copper miners, in my opinion. It needs to shift away from copper and base metal miners. I think that's a big issue that more people in the silver community should talk about, and they don't. They correctly identify the amount of paper futures contracts that control the price, but they don't talk about how the majority of the supply is produced by suppliers who don't care about the price. The copper miners care about the copper price, and they will sell their silver, they will hedge their silver, they will pledge their silver as collateral to save themselves. I'll answer a few questions here in the live chat. Will Plaza, from Xavier Ramos, will Plaza Accord bail out pensions? No, that's not. Devaluing the currency doesn't bail out pensions. Devaluing the currency lowers the debt in nominal terms. Excuse me, in real terms, it lowers the debt. So in nominal terms, you'd be, people who were holding U.S. Treasury debt would be getting paid back nominally. In real terms, they would be getting inflated away. So this is the difference. If you read articles from Daniel Amerman, Amerman, he's written a lot of articles about this. It's nominal returns versus real returns. Lynn Alden has been doing interviews about this. She just did an excellent interview on the Investors podcast talking about nominal returns and real returns for U.S. Treasuries. The same things are true with the debt. Excuse me, the same thing. It's exactly that. So it's nominal returns versus real returns. If it says you're getting paid back $1, but I devalue my currency, you're not really getting $1 in purchasing power terms. If I devalue my currency 50% and I pay you back $1, I only paid you back 50 cents. So this is what governments are doing. So it's not a bailout. Now, if they do print more currency and hand it out to the pension funds, that would be a bailout if they announce that they're going to print out currency and send it to the pension funds or whoever else, or buy corporate bonds. But then the currency units are going to be, we're getting into the Cantillon effect, where different members of society are getting different amounts of currency. Some people none at all, some people a lot. And then the purchasing power of the currency is going to start declining. Okay, this is a good super chat from Emmanuel Ananda. Thank you for the super chat. What can force the big manipulators, JP Morgan, Morgan Stanley, to get out of their short positions? Are you talking about the silver market? James Turk of Gold Money has said that it's just a managed retreat. So if you listen to Chris Powell from GATA, Gold Antitrust Action Committee, it is a matter of policy. So the bullion banks are in bed with the U.S. Treasury and the U.S. government. Rob Kirby would say that it's the Exchange Stabilization Fund. At this point, all these guys are merged. So the people that were saying the Fed's a private institution, over the last 3 or 4 months, basically the Fed and Treasury are merged now. So they're working together. I mean, they were coordinating things for a long time. But now with the official announcements that the Fed is financing everything and the Treasury officially owns a lot of this junk that's being financed. So it's a matter of policy. Back to the managed retreat. What this means is the manipulation will probably not permanently end. Does that mean you shouldn't not hold gold or silver or royalty and streaming companies or mining stocks? No, this means the prices will have to go higher. But you're talking about a free gold or free silver price. In the environment we're in, Emmanuel, I mean, there's less freedom. There's more taxes coming. There's more stagflate in tax and lie. A free gold or free silver price, I don't know if we're going to see it. We're going to see higher gold and silver prices. I don't know if we're going to see a free gold price or a free silver price. They will have to let the price go higher. They can only defend the prices at certain levels for a certain amount of time. This is why we don't have gold below $1,000 an ounce, $1,000 an ounce or lower, or silver at $12 an ounce or lower. Simply put, there's just not the supply to mine it. There's not economic supply to mine it there. Good luck finding a lot of gold mines that can mine at $1,000 an ounce. Now, there's gold miners that claim their all-in sustaining costs are $800 an ounce. But if you learn how to do run their financials and check it versus their free cash flow, their costs are not really $800 an ounce. Their costs are more like $1,100 an ounce or $1,200 an ounce for a lot of the gold miners. And for the silver miners, it depends on the silver mining costs. There's not as many low-cost silver miners. A lot of the good low-cost silver miners, Pan American Silver is one of the few ones. A lot of them are not in as higher cost silver miners. So what a managed retreat means is that your gold and silver prices are still going to go up, but a moonshot to where gold goes to 10,000 very quickly, the odds are pretty low. If gold going to $10,000 an ounce very quickly, because of the managed retreat, because of the games that can be played in the paper market. Look what they did in March. How many times did they raise margin requirements? I don't know how many of you were around in 2011, but they raised margin requirements 10 times in a week. When you raise margin requirements that many times in a week, that takes away. People are like, oh, I don't understand the margin requirements and how that affects the paper price. The hedge funds just decided they weren't going to be there. Well, why do you think the hedge funds got out when the margin requirements were raised? They got out because they saw the writing on the wall that the price was going to get smashed. When the margin requirements, and the hedge funds want more leverage. So when the hedge funds saw that the margin requirements were raised, they figured the price was probably going to get smashed. That's probably why most of them got out. Yeah, so the managed retreat doesn't mean you shouldn't have exposure to physical gold, silver, and the royalty and streaming companies, this managed retreat, they actually benefit from it. Because every time the price of gold or silver is capped at a certain level, if energy prices rise, the regular miners get in trouble, especially if one of them brings on a mine that's not on time and on budget, or the mine has production problems, or a government decides it wants to increase taxes because they saw the metal price go up. And then the royalty and streaming companies just do more deals. This is how Franco-Nevada is so big now. Over the last 12 years, they've done an insane amount of deals. There is no way Franco-Nevada could have grown this large if there was not paper price manipulation, in my opinion. No way Franco-Nevada could have grown this large if there was not paper price manipulation. They have heavily benefited from this. I saw an investor's presentation from a new royalty and streaming company, Nomad Capital, where there's an article behind my Patreon account paywall about Nomad Capital if you want to read it. You want to be one of the over 1,000 monthly Patreon account contributors, only $5 a month. And they said that the royalty and streaming companies, there's no barrier of entry, and only the large ones. The only advantage the large ones have is a lower cost of capital. That's not true. That's only part of it. The larger royalty and streaming companies have better balance sheets. They have better balance sheets relative to the other miners. So lower cost of capital, no, they have better margins, they have better cash flow, they have diversified cash flow, they have better balance sheets. It's not just cost of capital. Okay, I think that's it. I wasn't planning on doing that long of a show. I want to thank everyone for listening. Thank you very much to my over 1,000 Patreon account contributors. It's much appreciated. Hopefully I will be able to get an oil article out this week. That's my focus, to get a solid oil article out. There are a lot of articles and charts and audio podcasts behind the paywall. Articles about the euro-dollar market, the derivatives market, about Newmont Mining and Barrick Gold, and a lot of royalty and streaming company articles. Hopefully in the next couple weeks also I'll be able to get a uranium article out as well. But to wrap things up here, the British Empire, they had bouts of deflation, and people got scared, but they devalued the currency. And when they devalued the currency, the deflation stopped pretty quick. This is very similar to what the U.S. did when the U.S. devalued the currency with the Plaza Accord in 1985, and then when FDR devalued against gold. So the British Empire had stagflate and tax and lie. It was not called stagflation back then. It was just currency devaluation and inflation, higher consumer prices, misallocations of capital, and higher unemployment. And this is the bad part. They had high taxes and rules and regulations. And guess what the politicians did in the British Empire? They raised taxes even more. And guess what's going to happen now? Guess what's going to happen now here in the U.S., whether it's Chicago or so many other places? Guess what the politicians are going to do now? Even though the Fed can just print baby print, money printer go brrr. I screwed that one up. I didn't practice that. Anyway, though, the politicians, when in doubt, they're going to raise taxes. And this is the absolute worst time to be raising taxes. They should not be raising taxes. There should be shared sacrifice. The size of government needs to be cut. The economy is not doing well. It's not generating cash flow. We're going to have probably a really bad commercial real estate bust soon. Wells Fargo, I think, just cut their dividend. Although the Fed's buying individual corporate bonds, so maybe the Fed will just bail everyone out. Then there won't be a commercial real estate bust or banking system problems. Or that over $1 trillion in toxic sausage off balance sheet that Wells Fargo now has, maybe that won't infect everything. I took Spanish in grade school. I just didn't practice it. Money printer go brrr. Okay, I screwed that one up again. Money printer go burr. There we go. On that note, I should quit while I'm ahead.